All right, guys. Welcome to the third session of the equity research course, right? This course is going to be completely in English. So if you are a Hindi watcher or an Indian student, then this course is not for you. So first of all, this course is all about my international students. So let me just make the screen a little bit bigger. I'll just drag it over here and let me just present the screen. All right. So as you know, this is the third session. We have already covered what the buy side does, what the sell side does. And in this course, we are going to look at the two conceptual learning modules which are super important for your career in equity research or finance in general. And those two concepts are your time value of money and your accounting, right? Now, why accounting? Because it is the language of the business. Without understanding accounting, you cannot understand the equity research, you cannot understand the finance, basically, language of the business, right? And we are going to see why we are so focused on the accounting in this part. And then we will cover the time value of money, where the time value of principle says a dollar has a time value. It's as simple as that. That if you are owning dollars today, right, it is much more valuable than if you own the same amount of dollars in some distant future, right? So let's just begin. I'll just give you the exact definition of each and exact explanation of each one, right? So first of all, why understanding the language of business is super important for you? Because as Mr. Buffett once said that Mr. Buffett, who is the greatest investor of all time, said that understanding the language of the business is super important. Now, the question comes why? Because without understanding the accounting, you cannot understand the business because it is the language of the business. Your assets, your liabilities, and all the business transactions are done via an language known as accounting. So basically, consider it as the holy grail of finance, right? So accounting is the cornerstone of any career in finance. Now, accounting is a different term and finance is a different term. So even then, understanding equity research, you need to understand business. As I said in the first session, if you have not already done so, I recommend you to watch the first session first, right? Because this is an entire course, this is an entire series that I'm trying to upload on YouTube, right? And it is absolutely free, right? So make sure you watch all the sessions one by one. Take your time. Don't rush into the process of learning, right? So let's focus on the accounting first. And equity research is all about understanding the business and understanding the industry as well. So we will be talking a lot about industry research as well. So here are some basic accounting concepts and principles, right? So I'm not going to go into the detail of accounting because we are not an accountant. I'm not a chartered accountant and I don't plan to become one anytime soon. I'm just a equity research analyst. I'm here to teach you equity research and valuation. So to understand valuation and equity research, you need to have a basic knowledge of accounting concepts as well as accounting principles. And you need to know how the accounting statements are made and how do we read and interpret them. So let's begin. And folks, once again, if you have not done so, kindly follow me on LinkedIn as well, right? I'm active on LinkedIn too, but from far past few weeks, I'm unable to post anything. And I'll start soon to post something on it as well. So first, accounting principles, let's look at what is it. It's the accrual accounting principle, right? So accounting is, there are so many accounting principles in accounts, right? There are so many accounting principles. The number one of them is, and the most important one in my opinion, if you want to understand the financial statements and how financial statements differ from each other and how they are connected to each other. The number one is accrual principle. Now, what does it say? It is one of the most fundamental principles of accounting. In the accrual principle, it simply states that revenue is recognized when it is earned and not when the actual cash exchange takes place, right? So if you are just a beginner in the accounting world, you might be confused with this. Like, what exactly does it say, right? So it simply says whenever you make a transaction, right? Whenever you sell your goods or services to some customer, you need to recognize the revenue when the transaction takes place and not when the actual cash exchange takes place, because sometimes you will sell your stuff on credit, right? You might extend them credit maybe for 6 months, maybe for a year, right? They may pay you after a year, or they may pay you after 3 days only, right? So all of these credit transactions, the accrual principle says that you need to record the transaction in your books whenever the transaction takes place, and don't focus on the cash exchange. If the transaction takes place on today, right? Let's take example of you sell goods somewhere around 3 lakh rupees today, right? The accrual principle says, boss, record the transaction today only. Forget about the cash exchange. Whether it comes or not, you need to record the transaction. Now, why does it so important? Why are we focusing too much on the accrual principle? And why am I saying that this is the main fundamental principle of accounting? Because let me show you. Let me show you one thing. Let's go to the screener. Let's look at the let's take the company Infosys. It is an world-renowned company. Everybody knows about it. So let's look at the profit and loss account. Now, what is profit and loss account? I will tell you in further section. Now, just look at the profit number. Just a second. Here is the net profit. Right. Just look at the bottom. Here is the net profit numbers. Now, look at this. In year 2023, company has earned 24,000 crore INR of profits. 24,000 crore of INR profits, right? This is the profit metric. Let's go down. Let's look at the cash flow statement. The actual cash is actually only 22,000 crore. Now you might be saying the profit equals 23k INR, right? But the actual cash is 22.4k. Now why there is a difference? It's because of accrual accounting principle. The actual cash inflow in the business is 22,000 crores only, and the actual profit number is 23k. So the difference between the actual cash flow from operations and profit, it is because of accrual accounting principle, right? It's simply because of that, right? This is the accrual accounting principle. It says whenever the transaction takes place, you need to record it at that particular moment. Forget about the cash exchange. Just simply focus on the when the transaction takes place. So this is the most basic funda of accounting, that you need to record transactions whenever they take place, and don't worry about the cash, right? Just record the transaction. So this is the most basic and most fundamental and most important, in my opinion, the most important accounting principle, right? If you have any doubt, folks, kindly message me on LinkedIn, right? So just a second. Yeah. And in the second paragraph, as we can see, this is the most important to understand, as many companies sell stuff on credit, right? I have already told you many a times, you will sell stuff on credit, right? Because as a business, you cannot expect customer to pay you as soon as possible or whenever the transaction takes place. So when you sell on credit, right, you do not say, boss, I'll record a transaction some later date. No, you are going to record a transaction on the same date as and when it occurs. Record the transaction at the same date. Right? And the cash is received in some later period, right? It might be after 3 months or 6 months or maybe a year. Now, accrual accounting principle says whenever the transaction takes place, you are going to record it, right? I know I am being repetitive, but I want you to understand this principle in depth as possible, right? So you get the real picture of the business performance by looking at the operating cash flow and net income. Now, I have already showed you the real example of difference between both of them. The net income, in most cases, I would say, would be higher than the operating cash flow. Higher than operating cash flow. And operating cash flow will be lower than that. Now, operating cash flow is a part of cash flow statement, and net income is a part of income statement. Now, what is income statement? What is cash flow statement? I will tell you every single thing. I'll teach you every single thing in the further sessions, right? For this session, just focus on the accounting principle, right? So understanding the accounting principle will get you the basic idea of complexity of revenue recognition in Indian businesses, and not just in Indian businesses. There are so many businesses in which accrual accounting principle is being used around the world, right? So this was everything about accounting principle. Here comes the matching principle. Now, matching principle is like a brother of accrual principle. Now, what the matching principle says is, it tells that accountant to match the expenses of revenue earned during the same period. Now, let's say a transaction takes place. Let me give you a simple example to understand the matching principle. Matching principle says match the expenses in the same period. What does it say is, now let's say you sold goods for goods of dollar $10,000. Now to produce those $10,000 goods, there must be some cost, right? There must be some direct cost or indirect cost. Now matching principle says whenever you sell goods of XYZ amount, you need to make sure that you match the expenses of that particular goods that you sell in the same period, right? Match the expense in the same period, not at some later date. Now, why are we focusing on matching principle here? Because it will create consistency in the financial statement. That is to match the expenses related to the revenue earned during a period and matching the expenses with the revenue earned. So basically, to consider that whenever you earn a revenue, to earn that revenue, you need to sell something, and to sell something, you need to own something, right? So the simple concept is that whenever you sell something, there must be a cost attached to it, right? And that cost must be matched with the revenues earned in that particular same period. It's as simple as that. Now, it might sound a bit complicated, but in reality, it is quite simple, right? Let's move further. Going concern principle is the most easiest of them. Now, going concern principle says, boss, that whenever you start a business, we assume that business will keep on forever, right? We do not say that the business has an expiration of 5 years. We do not consider business to be something which will expire after n number of years. We say, boss, my business will keep on running on for generations to come, right? The third important principle for understanding language of business is the going concern basis. Now, according to that, my business will keep on forever, right? My business or any business whatsoever will keep on forever. There is no expiration date, right? There is no expiration date for the business. Business will never be shut down, and the business will go on till perpetuity, till infinity. That's the reason why I have given it the infinity sign over here. Now, why do we do this? Because as an analyst and investor, we cannot determine how long a business will go on to live. So we assume the going concern and make accounting accordingly, right? So this is the most basic accounting principle, that we do not know whether the business will be successful or not, or whether the business will keep on growing for years to come. So what we do is we simply assume that business will keep on till perpetuity. There is no expiry of the business, at least according to the law, right? There is no expiry of the business. So this was the going concern principle. Here comes the business entity concept. Now this concept says that the accounting for a business, particular business, whether it is LLC, whether it is LLP, or whether it is private limited, any legal form or whatsoever, it will be different from its owners, right? There is a business separate entity here. This is a business entity, business, and this is owner. Now, owner might be owning 100% of the entity, but according to the books, according to the law, business is a separate entity from owner. These two are different entities in itself. A business can be sued, a business can sue, right? We can sue it in court, we can take it to the legal court, and the business has a life of its own. We do not say that, let's take example of Apple Inc., right? It was founded by whom? Steve Jobs. We all know the Steve Jobs founded Apple Inc., right? We do not say that Steve Jobs and Apple Inc. are one, at least in the eyes of the law. Now, you might say, whenever you think about Steve Jobs, the only thing that comes in your mind is Apple. And when you think about the Apple, what comes in your mind? Steve Jobs. But understand this, business entity concept says, boss, both of them are actually different. Both of them have a legal identity, and they can be sued or can sue. So this is the most fundamental and most basic concept of accounting. All right, let's clear the drawings. In the eyes of the government and accounting laws, the business and its owners are two different entities. They are two different separate entities, right? Here is the owner and here is the business, right? Even though both are interdependent on each other, even then, this is a different and this is a different entity according to the books and laws. Each will have its own books, right? Mr. Owner will have its own books and business will have its own books, right? The transactions of the owner will be separate from the business. The business entity has its own life and it can be sued and it can sue others as well. So understanding it is so important to have perspective. Always understand this thing. Owner is someone who is running the business, but in the eyes of the law, business has a separate identity. Business has a separate identity, right? So make sure you get it in your mind as soon as possible. Owners are different and businesses different. So once again, I'm being repetitive over here. So understand this point that each has its own identity in the business world. Materiality concept. It is as simple as that. Accountants will only record those transactions which are material, which are relevant, which are economic, which helps in decision making, and which are big enough. Now, a particular accountant will focus only on those transactions which are highly material, which actually has some substance, actually has some substance in them, right? Without it, it will not be recorded. A 10 rupee transaction will not be recorded in a $1 billion entity, right? It's as simple as that. A $1 transaction will not be recorded separately in the books of account. It will be a part of miscellaneous expenses, right? It's as simple as that. We all understand that if we are talking about a $1 billion entity or a $1 trillion company, a $1 expense will not be shown separately on the income statement, right? Relevant transaction. A relevant transaction is something which is actually relevant to the for the stakeholders, right? Right. It should have relevancy for decision making. It should be economic. Only monetary transactions are recorded, right? Monetary transaction will be recorded. Helps in decision making. Anything which does not help in decision making for the stakeholders or shareholders will not be recorded big enough. And once again, it is a part of relevancy. So books you see are made using these concepts, right? You do not need to memorize them, but understand them at a intellectual level, that these accounting principles are going to help you in a super manner whenever you are reading the financial statements. Right. Let's move further. Revenue recognition. How a business recognizes the revenue is super important. Now, this revenue, whenever you see the top line of an income statement, I'll explain income statement in the next session, right? So for focus just on the revenue recognition part. So whenever you look at the top line of an income statement, it is also known as the revenue part. Now, what is revenue? Revenue is simply the money you earn by selling goods and services, right? So how you recognize revenue is a super important and crucial concept in equity research, because I am going to show you a lots of companies which are doing fraud in the Indian market as well as the foreign market. So how you recognize the revenue is a super crucial part, right? To understand this principle, we will look into the annual report soon in depth to understand the accounting. How a company recognizes revenue. How do they say that, yes, boss, we have earned the money, right? When do you say that you have earned the money by selling the goods and services? Because in many businesses, recognizing the revenue is super easy, but in a few businesses, recognizing the revenue is not as simple as possible, right? So annual report is the main tool through which we will understand it. And I'll soon bring the annual report part as well, right? So this is the most basic equation of financial statements. It simply says assets equal liabilities plus equity, right? If you know about the basics of the balance sheet, now I am going to explain what the balance sheet is in further sections. Then you obviously know that there are two sides of a balance sheet. One is an asset side and other is a liabilities plus equity side, right? Now let's look at the balance sheet. Just a second. A balance sheet has two sides: your asset side, your liabilities plus equity side. Now, liabilities plus equity says they show me the sources of the money, sources of the funds, right? It shows me the from exactly where the money comes from in a business, where they have raised the money from. And asset shows me the use of that money. So understand this point. These two will always match. They will always balance out, right? If the balance sheet is not matching, then there is something wrong with you, right? Something wrong in your calculation or your accounting knowledge. So understand this point that assets will always be equal to liabilities plus equity, because whenever you raise the money from investors, whenever you raise money from your financiers, whenever you raise money from your stakeholders, you need to apply that money. You need to use that money somewhere. And those assets will show you where you have used your money, and they show you how and where the money comes from. Right? So this was it for the assets equal liabilities plus equity. All right, folks. I hope you understood the basic accounting concepts. Now we will look at the time value of money. Right? Let's look at the time value of money. This is the central concept in finance. Finance, right? Right. Let's look at it. Without understanding this, you cannot understand valuation. You cannot understand investing. You cannot understand personal finances, and you cannot understand equity research as well. So focus too much on time value of money. And once you get the time value of money right, you can make your personal finance decisions in an easy manner as possible. So let's see what we have inside. Let me just give you the basic definition of it. What is the time value of money? The time value of money is a concept that says a rupee today, you might make it as dollar, right? Any currency you want. A rupee today is worth more than a rupee tomorrow. Now, if I have money today, whatever amount, right? If I have money today, it is it is worth more than a rupee tomorrow, right? It's as simple as that. Now understand this point. Because of four reasons, a rupee today is worth more than a rupee tomorrow. The first point is you can consume stuff today. Now, if you have money, you can buy something for yourself, right? Any goods, any services, whatever you like, you can buy it, right? Inflation is eating your money. Now in India, inflation is somewhere around 6 to 7%, or and you in USA, it's around 1 to 2%, right? So inflation is eating your money on a regular basis. We all know that inflation is a silent killer. Third, you can earn a return, right? By investing in any security, in any asset class, you can earn a return, right? Fourth point, future is uncertain. You never know what's going to happen tomorrow. So understand this point. Because of these four reasons, a rupee today is worth more than a rupee tomorrow. So looking at these points, even a layman will understand the having money today is far more valuable than having it sometime in the future. If you have money in your pocket today, if you have money in your account today, that money is super duper more valuable than the same amount in the near future. Let's look at further slides. So here are some important lingos that you need to understand. First of all, the present value. Present value of the money you have today. Now, let's say you own rupees. Let's say you own $100 today. This is your present value, right? Present value, what the value of the money is today in the present terms, right? Second point, of course, your future value. This is what your money would be worth in the future, right? Whenever you invest the money, you will have something in the future, right? So that future value is called the future value. It is also known as FV, and this is also known as PV. It's just the short acronym. Interest, the rate of return or cost of money, right? I'll elaborate both of them in detail in the further section. Now, understand this point. Whatever you earn on your income, whenever you invest, it is known as interest earned, right? Or interest paid whenever you borrow money, right? Payment. These are considered to be the EMIs. These can be considered as the periodic payment made or received, right? Whenever you buy something on installments, you pay EMI, right? So whenever you invest something, you might receive a bond payment and interest payment. So that PMT is the payment amount, right? Number of periods, how many years? N number of years, right? How many years are you invested? Number of years is the number of periods. Now, in the next session, we are going to do all of these calculations in the Excel. Understanding this concept is crucial to understand equity research and valuation. For valuation part, these become super important because without understanding this, you cannot understand the valuation, as these are the foundation of any successful finance career. Now, folks, if you want to make a career in finance and you are not aware about these five central concepts in equity research and valuation, then making a career becomes super duper difficult for you. So understand these points. Without understanding them in detail and without understanding the accounting in detail, you're not going to become a successful analyst. Now let's see what we have for the compounding and discounting. Now let's understand some equation and lingo of the time value of money. Compounding simply says when we go from present to future, it is known as compounding. What the discounting says, when we go from future to present, it is known as discounting. Now, formula for compounding is future value equals present value multiplied by 1 plus r to the power. Present value multiplied by 1 plus r to the power n. R is the rate of return that you earn, periodic rate of return. N is the number of years, how many years you stay invested for. Discounting is the exact opposite of compounding. You go from future to present, right? You are bringing your money back from future to present. Formula is present value equals future value divided by 1 plus r to the power n. This 1 plus r to the power n is called the discounting or compounding factor, right? We call it factor, right? In compounding, we go from present to future. In discounting, we go from future to present. So this is the most basic funda of compounding and discounting, and we are going to see a lot of it in the further videos, right? Valuation theory. The entire valuation rests on this one simple concept, the time value of money. Without understanding the TVM concept, you are not going to understand that valuation effectively. So to become a valuationary, right? To become a valuation expert, you need to understand the time value of money. Because we discount the future value of cash flows back to the present, we will look at the valuation in detail in other module, but understanding them requires understanding the TVM. So understand this point, that you need to make sure that you understand the valuation theory better you need to understand the time value of money better to understand the valuation theory better. So folks, this was it for this session. I hope you loved the session. If you have any doubt, kindly message me on LinkedIn, right? So make sure you share this series with your aspiring analyst and investor friend. Folks, please do this now. Like the video and kindly subscribe to this channel. A lot of educational content is on its way, and hit the bell icon too. And follow me on LinkedIn as well, right? And I hope you loved the session, folks. And kindly share this with all of your students and all of your friends. And with this, I'm signing off. Bye-bye.